Going for this video, I'm going to be talking about risk to reward ratios and why it's important that you over time learn to maximize this to the best of your ability. Um, Essentially, what I just want to briefly talk about is that um, it's something called liquidity. Let me just liquidity. Oh, liquidity. Now, what liquidity is orders, positions, money. Liquidity is basically money. And what I mean by that is above and below market structure lies money. So, for example, if there's some people who anticipate price coming below structure and they place their orders below this level before price even decides to come down. So they'll probably place the orders like around here, their buys, right? In anticipation of price reaching that level so that they can basically in a way predict, like in a way like be ahead of like price in a way. And if you think about it, those who are buying will have their stop losses below this level here, for example. So say someone thought that from here price was going to start trending upwards and they bought, their stop loss will be just below here, right? And if price was to trend downwards, it will take out their stop loss. So it would essentially take their liquidity, it would take their money, right? Now, you have buy stops, sell stops, buy limit, sell limit. This is all in the foundation course. So if you don't know any of these, you should go back into that and teach yourself that. But essentially, how to maximize your risk to reward ratio is to understand how to take your profits, how to take your partials, and how to best maximize your risk to reward. So I just want to quickly show you something. Let's say, for example, this here is a trade of someone and they want to take their profit when price takes this liquidity point here. So obviously whoever was selling here, right? Let me just give you a better representation. So let's say someone sold here. They have their stop loss here, right? The market is obviously going to be maneuvering in a way where it's going to be continuously breaking this structure to the upside, seeing as now it's in a new trend, right? See here? Price broke structure to the upside, comes back down, breaks structure to the upside. So those who are selling, their liquidity is being taken. You see that? Those who are selling, price is now coming against them and it's hitting their stop loss. So whoever's selling now is all getting stopped out. So what you want to do is you want to put your take profit at these levels. When you're buying, you want to put your take profit at these levels here, right? And what this is called is external range liquidity, but I'm going to go into that in another video just to help you understand that better. So let's just say, for example, here you have a, let me just show you this a bit better. Let's say, for example, here you have a 30 pip stop loss, right? With the 30 pip stop loss, you're going to make, and I say 30 because if you go on like Baby Pips or any of these retail concepts and strategies, or anyone on YouTube, basically they'll teach you, yeah, you just buy off of the 618 like so, and you have a 30 pip stop loss, right? So they're like, yeah, you just buy it off the 618, have a 30 pip stop loss to account for any leeway, and that's how you take your trade. So let's say you do use that concept, right? You're going to make 9% back in a trade. Whereas if you use the concepts that we're teaching you, you'll actually tend to make more. So let's say your take profit was up here. You can, simply because you're understanding price action better, you can afford to have a more precise call, therefore maximize your risk to reward. So Whereas these two are the same setup, they're the same trade, you can afford to have a 10 pip stop loss, or let's say a 5 pip stop loss, or let's just say, like I showed you in the previous video, a 7.5 pip stop loss. So whereas here you made 9%, here you're making 14. So why would you want to take a trade that's not making you as much money? You don't understand the logic behind the trade and why it actually worked out in your favor, and not knowing that will make it more difficult for you to replicate that trade in the future. Whereas here, you do understand that, okay, there was an inefficiency here, price, it lined up with my, sorry, give me a second. It lined up with my structure. Price broke structure to the upside. It came back down into my inefficiency. Logically, the trade makes sense. I know why I'm taking it. Therefore, I can have a more precise call. And let's just say this does decide to go higher and higher, your risk to reward ratio will be maximized drastically. Like, look, this is now what? That's 43%. Yep. And let's just say this does decide to go higher, that's only 13% now, just because your stop loss is so, like, you have such a large stop loss. Think of it this way, yeah. If your stop loss is 30 pips, to make 1% back, you need to get 30 pips, because that's a 1-to-1 risk to reward ratio. Whereas to make 1% here, you just need to hit 7.5 pips, which is less than like 50, like less than half. Like, you need to, price will have to move such a small amount for you just to make 1%. Look at the difference. Look at the difference. Learn to maximize your risk to reward, and trust me, you'll learn to take less trades in the week but more effective ones. Simply by learning this, I take one trade a week, because there's retail traders out there who take the same trade as I do, and I'm here making what, like my previous GJ trade, I made 25%, whereas if I took it using retail methods, I would have made what, 10%, 11%. So you're literally receiving double for the same trade, simply by understanding why it's working. So that's how you use risk to reward ratios, and understanding risk to reward is going to be so beneficial for you. I can't even like explain. And also, when you're looking at when you're growing your account and you're compounding, don't look at money as like a, how do I say this, as like a value to like calculate your growth. Look at percentage. So when you're taking a trade, look at, okay, cool, I'm gonna make 5% here, 10%. Don't think of it like, oh, I'm gonna make £20 and I'm gonna exit. Think of it as a percentage, and trust me, your account growth will be so much healthier. Besides that, I don't really have much more to talk about in this topic. Actually, just to show you this example, so this was the let me just delete all of this. Oh. This was the equilibrium setup that I showed you guys in the previous video. So if we just zoom in, right, this is a perfect example of a precise call. I knew that price was consolidating, and once it broke out, like we saw here, we had this breakout, we waited for price to come back in to this consolidation region before taking our position, right? So once price came back down, we saw that it was going to come to the 50%. Just zoom in for you. Give me a sec. We knew that price was going to come back into the 50% before moving higher. Knowing that, we managed to take a trade with a 7.5 pip stop loss. Whereas if this was 30 pips, Look at the change. Look at the change in your risk to reward ratio, right? So here, should this have been your full take profit, right? You would have made 67%. Should you had a 30 pip stop loss, you only would have made 16%. Look at the difference. Compare 60% to 16%. So if you take one of these 60% trades, yeah, you could be done for the month. Whereas you will need to consecutively try and make these unprecise calls, not really understanding why you're taking. Trust me, you want to understand why you're taking these positions, maximize your risk to reward drastically. Look at this, 7.5 pip stop loss, and you're getting 60% back in one trade. Learn these concepts and you will maximize your risk to reward drastically. Besides that, thank you guys for listening, and on to the next.